So I think we can get started and just keep chatting. Usme ye hai ki we can just as people come in, we can keep adding them and keep repeating stuff. So first of all, have you guys started trading at least in the virtual account, or is it something that you don't even know the platforms? I mean, any platform related questions? I know people are using Robinhood and Thinkorswim, Interactive Broker. I personally use Thinkorswim, and I also have an account with Interactive Brokers. So any questions regarding brokerage or generally getting started? I'm happy to answer any of my experience based on my experiences. So feel free to ask. Everybody is open to make comments here. So, okay. Generally, my advice is to use Thinkorswim. I personally think it's easier to use. There's a nice virtual account which I purposely put up here in the screen. I'm happy to go over it if you think that will help. But generally, that simulated trading is actually a good way to get started. You can place some trades just on a high level. It just gives you a little account information. Obviously, this is all similar, paper money. They have obviously their trader TV and live news, which I never use because during the day, obviously, we are working and so there's no time to do that. But then there is a watch list, which you can add different pictures, whatever you wanna like. Let's say we have a till rate trade, so I will just put that up there. There is this charting as well. You can put something here and it'll chart for you. So let's say this one, right? So these things you probably can explore a little bit. But what is more important is obviously the options platform where you have your positions that will basically show up right here. And then once you click on the trade tab, you can see. You can just let's say we put Neo here. You can see the different expiries, and you can click on them, and for each expiry you can see different. Left side is call options, right side is put options for the 15 January 2021 expiry. There are other controls like implied volatility. There is probability of in the money. You can actually customize it also. If you want to use different controls, you can just go and customize them as well. I generally use these because those are important ones. Are volumes. You want to see something you trade where there are thousands of contracts that are being open, because otherwise that bid ask spread, it should not be too much. Yeah, so that's pretty much the platform. I mean, you can analyze different trades. Those are also like, for example, this till rate trade that we have. You can just analyze the trade and see the risk profile of this. We can get that deeper into that. But generally, if you want charts, you can look at the charts and set your controls here in the settings. And this stuff from your stock trading experience, you probably already know. So I don't know how much useful that is, but so what we are doing is really starting with some. I mean, we put some trades up there, and what I'm doing is I'm trying to keep a log of everything we did during the month of November, and we will keep doing that as we go through. Maybe on a monthly basis, we'll see how we are performing. If something is not working, we will change it. Some strategies may work for us, some may not work for us. Based on my past experience, I generally like to do spread trades with the combination of calls and puts, because naked call option, naked put option, generally, in my opinion, is more of a speculative bet. So you just put like $300 trade on the table, and on Friday, if it's out of the money, then you lose all that 300. So that to me is more speculative. Now people do it, and I have no problem with that. Generally, I just feel that what the option sellers do is they put that weekly calls in front of you, right in front of you, the 27th November, and most people go and click here. So for example, let's talk about Neo, right? So the Neo stock obviously is a hard potato right now. Everybody wants to get a piece of it. So what the option traders will do the option, Chicago Board of Option Exchange and some of the other, wherever these options are coming from, what they do is they put that in front of you. Let me close that. So generally, most people try to load those front month or front week. 27 number is week from tomorrow. 5 more trading days left in there, and then 4th of December 11. So those maybe first, I would say 30 days, people are very highly interested in those. Why? Because of the leverage. We have talked extensively about the leverage, how that leverage works. I mean, looking at NEO, 27th November at the money is like $50 strike. You're getting an exposure for, just take the middle of that, $215, and you have exposure on 100 shares of NEO. And like we talked about the leverage, that's a lot of leverage. If you buy a NEO stock for like $50, right? 100 shares would be, almost $5,000, and you get exposure, obviously for a lifetime, owning 100 shares. But on the other hand, a $50 stock, and if you're paying $215 for that, that's 2.15. So, you're getting 23x leverage, so generally people get attracted to that, because these are very, affordable. $213 for 1 week time on NEO. Anything over 50 is yours. Obviously, after the cost of trade, the 215. So basically, a break even is 50 plus 215. So it'll be 52.15. We have extensively seen how it moves plus or minus $10 every week. So, if you were right, it goes to 60, you get everything after that. So the 50 plus 2.15 would be, so that's where your break even is roughly, so if it goes to 60, you basically end up making, pretty good money there. That times the 100 shares, so it'll be like, $785. So that's very attractive. On the other hand, you have to put, $5,000 where you played the game with a very little money. So that's why they generally put those, and people bounce on it. You see thousands of contracts are outstanding on that 50 call. Just in 1 week, 56,000 contracts are outstanding. Actually, that's a volume. So on the put side also, it's pretty. Actually, this is interesting. This 56,000. That's a very normal. So that I just spotted that. So that you could see that that's a special. People are, so if you look at the put side is not as much as the call side. So maybe there's people expecting it to go higher next week. But sorry, I'm keep talking, but I let you guys speak up. I mean, this is not to really kind of lecture you. It's just all interactive. You guys ask questions that, and even whatever basic questions, I'm happy to help.
Hello.
Yeah.
Assalamu alaikum, Raheel bhai. This is Numan.
Assalamu alaikum, Numan. How are you? Is it Numan or Khyam?
Numan Hadi.
Yes. Numan, kaise ho yaar?
TikTok. So I'll take this opportunity to ask all the stupid questions that I have.
No question is stupid, yaar. It is all. I want to break that ice, because it's not about me coming up with all this and you guys not picking it up. I mean, personally, I don't have any incentive of engaging you, and my only goal is that I place those trades and people don't know what's going on, and I just took a little time on a Sunday evening just to answer questions.
So going back to your US platform.
Yes.
So when you're trying to place a trade, do you look at the probability of in the market and out of the market, and do you look at implied volatility?
Yes, it's a great question. NEO 50 call has a 43.29% probability that it will give you at least 1 cent in the money. That's what this means, probability of being in the money. Honestly, I don't quite see that. I have it in front of me. Yes, it's a data point, but I typically see the biggest things I see in something is intrinsic and extrinsic value, right? You're already on that 50 call. You are paying $215 for something that is 75 cents out of the money. So it has to clear a lot of distance. So to break your 52.15 minus the 49.25, right? That is a distance of almost It's a distance of almost, so $3 movement on a stock of 49.25 is about a 6% move. Yeah. So first the stocks gotta move in your direction, and then to by 6%, and then you start making money. That to me is a more valuable data point than actually looking at this. Probability is calculated by their algorithm, and yes, it's some data point, but I don't quite pay a lot of attention to it, honestly.
Okay, because so I follow one guy. His name is Kirk from optionalpha.com. So he normally recommends to look at 70% probability of in the market. So let's say at 18.78.
So it'd be 46 strike. Okay.
Yeah.
This one.
This is what he says, that this is a good buys, and look at the 70% probability, and that's a good price. That's a good option price that you can start to begin the trade.
He's absolutely right. Why? You want to buy deep in the money, because here the value is a lot more, because you are in the money by, sorry to cut you off, but it's important. 46 strike, 49.25. So you're already in the money by 3.25, and extrinsic you are paying is, what was that price of that? 435, let's say, right? So you're, so 435. So basically you are paying almost just, this is much better value than that other call. So that's why I always say buy. So this is actually a very good trade, in my opinion. You're putting, but then you're putting $435 goes south, then you lose that. But hey, I would do this one more than that other one. Very precisely right.
What about the other way around? So if you go back here and look at the other side of the normal distribution curve at 18.78, $55 call, isn't it much cheaper?
So it is cheaper and a very nice leverage, but hey, you have to move almost 20. Okay, let's take a look. 55 strike is $80, 80 cents. Hang on. Yeah. So 55 strike is how much out of the money? 55 minus 49.25, almost. And then I just look at the percentage move it has to do. So that's about 49.25 strike price. So 11% move, and then you have to actually add the price you are paying for that too. Right. Because you have to actually, this is not 55, the 80 cents you have to pay also. So you start making money after it really moved about 13.
Yeah, but this is gonna work out. But so we are not doing a naked calls, right? Let's assume we are selling a high employed volatility option.
Yes.
With this strategy. Right. Wouldn't it be more valuable for us?
So let me talk through that. I get your question, but guys, anybody, this is a very, Noman, I truly, it's a good way of thinking. Anybody else wants to chime in here? Anybody else thinks that it's not making sense, or it's making sense? I am happy to. Otherwise, I'll jump right to what Noman is saying. I know what his question is. Okay. So Noman, the issue is this. I hate to buy stuff here on 5 days calls, unless you are you want to really place a bet where something is going to move heavily. What I would do in this case, if I am bullish on NEO, what I would do is I would go deep in the, so we actually did a trade like that. We did. So here's what I would do. This one right here, diagonal. So I bought a 35 deep in the money strike, May 21, with about 6 months time in my pocket. Right. And then I sold one. That time, I think NEO was around $42 or something. Right. And then you sell one out of the money weekly call. Why did I do that? Is because these are expensive, in my opinion. They're priced in very, very. I mean, first you got to move for almost 14%, and then it starts to deliver for you. What I would do in this form is this trade I'm going to make in front of you. So I would not that much. I would probably select, I mean, it's up to you, but maybe let's say 3 months, right? 3 months deep in the money, 49. So let's do 45, 3 months, about that one. And then I'll sell them. I want to take a little upside. So I'll sell them maybe 10% out. So actually I will sell this one. And that way I am actually, so $9.20 for this trade. But guess what? It's already $5 in the money, and you have 3 months time with which one I did? Yeah, almost, yeah, January. So you have two and a half time, 2.5 months time. So that's the way I would play. But you can, if you play naked, like you buy that one, it's very, unlikely you'll make money. And the probability is showing you that 55 call. I mean, your chance is about 18%. Now, I'm not saying next week it could be 60 and then you make a lot of money, but it looks a little highly unlikely to me. I don't know if it's a perfect way to lose money unless you think that it's truly gonna move. I mean, people are holding a lot of contracts. It can happen, 18-20% chance, but would you not give your 70% chance and just pay a little more?
Right. No, you're right. So one more thing that I look at is that if the employed volatility is high, the option price is higher because you are factoring in that the stock is going to move much higher, and in reality, it doesn't move that much. So historically, the volatility has been less than the employed volatility, and that's what we're trying to say, right?
Yes, exactly.
So
But and decay also, because every day this 80, if it doesn't move so
yeah,
this is a short week also, that you have to remember that we have 3.5 trading days, right? For that 3.5 trading days, paying 80 cents for something that is gonna not help you with 13% move upward. Now, New York generally every day is moving a lot. I mean, if you look at this one, right? This is even more. So this is like $12. Now, if you go 12 strike, if you go 15 strike, look at what that. Does not have weekly options. That's a problem. But if you look at this one, this has got to move. Actually, this one is not as bad. So 12. So you have 4 weeks, 12 at the money, and you are paying about $250 for that. But then you have 4 weeks in it, and the implied volatility is pretty high. But then this is a very volatile stock. Every day, it moves a lot. So it's really your belief at the end of the day. You really think it's going to do something or not. Now, the volatility here is pretty high. But I feel that this is going to show a lot more volatility. Sometimes volatility is your friend. You really think
but
okay, one more.
how do you find out, or how do you make a decision that this option is priced right and it's not an expensive contract?
Okay,
How do
so
you make that decision?
right, so that has to do with potential move that is built in it, right? So one of the things that I look at is obviously, there is this 182% volatility. Now, sometimes you have experience like AMD. I trade a lot, right? In AMD, I could generally see, 85 strike. See how low that volatility is, about 37%, and it
Right.
generally moves about, it's not gonna move your 10%. Very, very rarely it makes a 10% move, or even in 5 or 6% move. But the stock that I was showing you is electric vehicle company, right, or technology company. Those move large, so you have to compare. But by the way, that was a 4 week. This was, I need to compare apples to apples. So this was this one. Right? So 85 strike on this one is about 44%, right? So you have to see, this is a stable company. AMD is not gonna see something like that happening. But that electric vehicle company, you can see it at $6, or you can probably see it at $20. So that's pricing right versus. I mean, there is no, even these option guys, they don't even know if it is right, because otherwise you would always, either it is overvalued or it's undervalued. Nobody knows its correct pricing. What I typically do in this scenario is I would just buy something out of at least 30 to 60 days out, and then I'll try to sell out of the money calls here, because those are going to be definitely expensive. Like if you look at Neo, back to Neo. So like I said, these ones are these ones are a little bit pricey in my opinion, unless you actually go in the money. So if you are bullish, you are absolutely right. You have to see this, and you have to get a better value. And like I said, you are buying extrinsic value of only $110, and then so I would go and buy this one, because you're already $3 in the 3.25 in the money. So yes, so this is all there's no right or wrong answer here. It's all about your intuition, how you think that you want to play this. 70% this one is a good call actually. In fact, what I would do is, in this case, I would buy a 46 call, and if I really have to play weekly, and I'll buy like a little out of the money put. Maybe I'll give myself like this one as well. So now I'm very like, this is kind of a straddle, not really, it's a strangle really. Is you're buying 46 call, but then you are also worried about downward. So just buy a little on the downside as well. So your total cost is gonna be, no, sorry, this is buy also. So I gotta, yeah. So yeah, so just by paying a little more, like $58 more, you are actually also protected a little, because what if it's at $40 or if it's at $38? So decay is gonna hurt both ways now, because this strategy, the problem with this is like, what if it halts around in that range? It's not gonna be, its break even is actually now either 51 or on the lower side is gonna be 39. So you have to see the trade. Yes, 39 here and probably like 51-ish there on that. Yeah. So yeah, so see, you have to see that where you feel that you are comfortable. I don't think this is a money losing scheme here. I think it's not gonna be below 39 and more than 51, but I could be totally wrong. This is, as you guys are probably smarter than me in finding that out.
Should be so close to the expiration date, or should we try to get out of the trades like 20 to 15 days before the expiration?
Generally, for naked calls, I would not hold it for last 2 weeks. I will get in 60 days remaining, and then when 45 days are over, only 15 days are left. Because the decay is going to be really, really sharp in the last few days. And I think.
So my follow-up question is, for Tilray trade, why are we so close?
Let's talk about Tilray now. That's yes. We are not close. Let me build that one. That one is a very interesting trade. Okay.
Yeah.
So.
Good question on this new.
Sure, guys. Sure, go ahead. I wanna. Okay, go ahead.
So let's say one was the diagonal that you mentioned. We were paying like 9.2 for it, right? But for vertical spread, that's like a 4.23.
Right.
So like, what intuition we should have, like say when we are looking at, hey, this premium is justified, right?
So one of the things you can look is a historical. So most of your question is that probably the same question as Numan had. How do you know if it's overpriced or underpriced? Is that your question, or your question is that?
No, it's high.
How do you?
It's high volatility. Let's say we can sell a call option out of the money call option, get some credit for it, right?
Right.
But the deep in the money call that we are buying, right? Can we buy it a weekly expiry, or do we need to get like 20 days or 30 days or 60 days out? Right?
You can buy anything. You can buy both front week options. That's not a problem. Let's talk about Tilray trade, and I'll come back to you and explain the way I think. Okay, and this is not saying that the way I think is right. It's just the way, I have learned over the years that these things decay very fast, and I don't want to hold those front month options. I want to actually give to somebody else, and that's why those guys are trying to sell you those options front loaded with thousands of contracts, because you are going to click on that first available option and play, because it's tempting. It honestly is tempting, because it's lower cost and it's gonna but generally. So let's look at the Tilray trade. Let's spend a couple of minutes on that, and then we'll come back to this topic. What I did here is this. Tilray, first of all, the first thing I did was, obviously, I look at its 52-week low and 52 high, and over the course of the time, I think I have some opinion about it that these companies, this should probably not drop below $5 that easily. You can probably drop to $4.50, but it's not gonna. Hopefully, it's about $1 billion company, and I doubt that it's gonna decay. It's gonna lose value to like $2, $3. It can happen, but so my thought was this. If you only buy Tilray stock, that $736, right? And 200 shares would be just about $1,500 or $1,600, something like that, right? What I did was, I instead looked at 1 year, about 425 days, and I looked at Tilray 5 call, this one. And when I placed that trade, I saw it's about 2-to-1 leverage because the stock was at 7-ish, and I was getting it at, I have the data here. So, but it was about $325, and the stock was around $650, right? So I was 650 or 7, something like that, right? 650. So I was saying I'm getting 2-to-1 leverage. So if I hold 2 Tilray calls, I'm paying $650 for that. But then I have 1 full year of Tilray in my hands, right? And that's not a lot of money. Let's say that because I have 1 year and I can afford to lose that. Let's say, right? Now, one way of thinking it is that this will keep going up and probably become a $10 or $15 stock, and that way your call is going to deliver huge for you. But if it stalls, so what I did was I actually looked at the pricing on Tilray for the weekly call, and this is the most important part that I want to emphasize again and again. The $7 strike, look at how much expensive it is. Or even 7.5, it's $60 just for 1 week. And that same 7.5 is going to be $290 for 1 whole year. That's where that decays. So if you want to hold, so this is way too expensive for me to hold because this is number one out of the money. And then you're asking $60 for me just and look at this. Sorry, this is 4th December. This one right here, right? Still, it's $39. And so why not take the credit? Now, 2 things can happen. So the way I structured the trade, I actually, at that point, this was data. So I picked up $36 credit for a $7 sell on one of those. That's important. 2-to-1 spread. Now, what scenarios can develop, right? If Tilray keeps going up, goes to $10, right? By let's say next week, right? You are the winner. You are going to make 10 minus 5, which is your strike, right? And 200 shares holding. And actually, there's going to be some time premium as well, but let's even ignore that one, right? So yeah, $1,000 worth of, because this is going to really, you have 2 calls and they are going to almost have a delta of 1. Let's look at the delta of that. $5 call. Delta is, no. I gotta go and this is not my real account, so I know how to yeah, it's all here. I want to see the delta of this, right? So this is 1 year out, $5 strike, and this is the delta, right? So $5, yeah, 81% delta. That's a really good delta, right? So I'm gonna make the big move that Tilray is gonna do. Let's say that rough calculation, right? So Tilray is going to go $3 in the money, right? $3 upward move. For that $3, I am collecting almost a delta of 0.81, right? And then I have 200 shares per year. So I am actually going to make $486. Now somebody can say, hey, you sold that $10, the $7 strike. So for that strike, I don't care because for that one, I do have to, and that one delta is, let's take a look at that delta. Well, delta is a dynamic phenomenon, it keeps changing, but just as an approximation, that 7-1 has a delta of 0.67. So just let's say that $3 move was gonna definitely hurt you as well, but hey, you already collected, it was a 7 strike, you collected 730, so up to 736, no advantage. And even you take the delta of 1 on 1, right? So then still it's $10 minus the strike, which is 7, but you also collected some money, which is 36 cents in that case. And this all happened on 100 shares. So still you are the winner, although this calculation is a little bit, I did not include the time value of this. This option is going to still have 1 year time value in it. So this realistically, that number will probably be around 300 or so. And that 300 on a 614 investment is 50% gain. So on the long side, if Tilray keeps going up, I am the winner. And you know why? Because we are holding 200 shares exposure and we have sold only 100 exposure, and that too out of the money, and that too with a credit of 36 cents. So why wouldn't it's a great, I would love it to move up. And that's why you saw that on Friday, it moved up, and our trade was actually delivering for us because we were seeing pretty good gains there on that one. I think it was like 10% or 15% up at that point. So going up, I'm winner, right? Now, if it doesn't go up and actually halts there, still I am keep collecting to $36. So let's say it did not move at all in that 1 week, the 5 days. Guess what? You got that 36 in your pocket, and now your cost of the trade is that 614, and next week you are gonna sell another one for say 36, one more week out, and your cost is gonna go down by 36. And then again, one more week, same thing. You keep taking those credits week after week after week, and it is gonna keep stuck. Eventually, it will lower it to like almost nothing, and you are holding 2 contracts for almost a year. Upward side, you have that 2-to-1 spread. So if it goes up, like I showed you, you're still the winner. If it goes down up to say $5 or so, you can still keep selling that contract of that. In that case, don't sell the 7 because it won't have a lot of value. Sell the 5 or 5.5 or 6. But we'll keep collecting those credits as it keeps falling, and then keep lowering our 614 down to almost. And over a period of 1 year, you can bring it down to like 300 or sometimes, so that's called a renting an option. Like every week you're selling those guys the expensive out of the money weekly options and collecting credit for it against, and you're holding those for a year. So you will not see the decay. They will see the decay. So that's the whole logic behind that trade. Happy to answer any questions here.
So now that you already sold that $7 call.
I sold it at 34. Now it's at 60. Yes, go ahead.
Yeah, so essentially it's a loss for $20 for us, right?
Yes, but look at the gain. Yes.
Right. Yeah. So we gain on the other side. So now
we gain almost 100. And yes. Let me see what is. Hold on. Let me make the trade. So we have $5. Buy this 2, and then sell 1 7. Even now, right now, the value of this trade is 2-to-1, 665, right? And I entered at 614. So going up, you are winning it very comfortably.
Yes. So now you're saying that till 20. So our next move should be to rent it out, because
now what I will do on Friday.
Yeah.
Let's say this. What I will do on Friday is very simple. I will wait it on Friday. First of all, let's say that it did not move any more in 1 week, right? It still is 736.
Yeah.
I owe the guy 36 cents, but I took the credit of 36 as well, right? So I will simply buy it and I'll roll it. So here will be the trade. Let me give you the trade then. I will buy it back, buy this back, and then sell another one, which will be more money. And now looking at that strike, I'll probably sell, let's say, just sell it, this one. Let's sell this one. Hang on, what's wrong? 7.5. No, 4th December I sold 7. Yeah, so now you are up 750. So you are actually moving up. So maybe I'll not sell 7.5. I'll actually sell 7. So yeah, you can get in that $21 credit.
I will do that.
Yeah, I generally try to. It depends on. So because I am holding 2 longs and 1 short, I will not do this one out of the money. I'll like to take some. Actually, you know what? I'll probably sell 6.5 and get 38 cents credit. I don't care if it keeps going up. I am the winner because I have 2. You have 1.
Yes.
So that's the thing. But I don't know what I will roll, but I'll see. It depends. The problem is deep in the money selling is not good because there's not much time in it.
Yes.
The time value.
The important thing here is that we have to do something about it. If it is at $8 and somebody calls it, we have to buy.
Doesn't matter. No, nothing will happen. No, nothing wrong. If you don't do anything about it on Monday, what will happen is they'll put 100 shares on you, right? In fact, I would, if I'm busy somewhere, I do not care. Here's what will happen. So stock was 736.
Yeah.
Let's take a look at it, right? On Friday, we were busy. We were going somewhere, and it expired, right? So what will happen is that, hey, you have to deliver the shares at $7 and the stock is 736. Right. So what they will do is they will make you short 700 shares. 100 shares, right? And but you have long 2 call options. So you just come on the Monday and just sell this back. No, you're short. You buy them back and then sell 1 call option back to those people. So that here's the trade will be. Let me show you. So the trade will be custom covered calls, covered stock. Actually, I like to do it. You could do it in 2 steps, right? So you go here and do like a buy back 100 shares of Tilray. Just buy it at whatever price, and then You just go and sell one call option like you always do. Nothing wrong with it. They will know that if you have something that you tell me what worst can happen.
I mean, I was thinking that, okay, somebody can exercise their option and they can add, let's say the Tilray stock is at $10 and somebody,
Right.
the broker can reach out to me, hey, you need to deliver 100 stocks at.
So then deliver it. So yes, so I will deliver it because so I lose 300 on it because I have to deliver at $7 and now it's $10. The guy was gonna, so you have to buy at $7 when the market price is $10. So there's $300 lost there. Agreed. You are $300 lost there. But hey, your two call options probably deliver you $600 worth of profit.
Oh, okay.
So you would simply say, okay, take it. I'll buy it. Take it from my. Even they will not even ask you for, I don't think it's a margin issue too, because they simply will put those stocks in your account as shorts, right? On Monday, you will see short position of 100 shares, right?
Okay.
Go and buy those back and then sell one more call option in the next trade and you're back to the same situation.
Got it. Makes sense.
So that's not an issue. And if it goes down, then hey, your option is worthless. So I can wait 1 year. You don't have time to wait one. Yours is worthless. So I'll give you another one for one more week.
Right.
So you recommended that we actually try to sell it on Friday, right? I'm sorry, buy it back on Friday.
I generally don't get into this stuff a lot. I generally roll it. So here will be the trade on that Friday. So I would see whatever the price is on Friday for that Tilray call, $7 strike. I'll want to buy it back. So I'll say, buy this one back for me and then sell. I have
sell another one.
Maybe I'll sell. If I am bearish on it, I see, this week is not looking good. I'll probably give myself a little, I'll probably sell the 6-1 or you also have to see these bid-ask spreads. They look very weird right now because the market is closed, but this one is fine. So I'll probably just sell another one and I get $21 credit this week. I'm okay.
What's the reason for waiting until next Friday? I mean, what do
the decay is really severe on Friday because you will see Thursday and Friday, these things lose value by the minute. And we saw that on Friday in the NEO, right? I had a nice chart there with the, decay. The decay is really, even on a Friday, that last 3 hours, the decay is really severe. This will still show an extrinsic value of about 15-20 cents even on Friday because 20 cents moving for Tilray is not much. He moved 63 cents on that Friday. So they do keep that 10 or 15 cents. And sometimes because of that little 10 cents I want to capture, I let it exercise. Give me the 100 shares short. Now there are two advantages of that. Sometimes I wake up in Monday morning and I see Tilray down 50 cents. Then I can buy them back cheaper and then I can wait because my two naked calls can stay like that for 10 days, 15 days. And then when the price is right, I'll sell it again. You don't have to sell it every week. I mean, you can take a break with 1 week. You say that, hey, now it's $5. I really don't think it's going to go further down. I don't want any credits. I'll leave my two call options open. I have 1 year time, so I'm good with that. You could do that. You don't have to roll it. If it goes to 5, I will not roll it. I know I will not roll it. I will only roll it if it is around 6.50, maybe 6. If it maybe even 6, I will not roll it. I'll just simply buy it back. Well, it will be worthless because it actually dropped down to 6. So I'll take a break with selling for 2 weeks or 1 week until I see it back at 7. Then I'll keep selling. Does that make sense or no?
Yep, it does.
Yeah.
Because I only want to sell at 7. I think at 5 it's very undervalued, and I am okay to wait to. Okay, I'll give you another example. Like
if to go further down, so there's no point selling a call anymore.
Right, exactly. Why would you give the other guy an option that okay, what if in that week that you sold a $5 call, you went to $10? So I will sell at a certain level, and then I'll not sell it. I'll keep it like a stock. I have my investment down to. So this cost was $614 at that point. Let's say after 3 or 4 times iteration, now my cost is $500. I will not sell it. I'll keep it for 1 year. And if I was truly wrong and it bankrupted or it became $2 stock, hey, that happens in stock market. So $500 will probably be like 200 at that point. So I'll take the loss and move on. And well, I'll keep it for 1 year and then I'll take the loss. And I can afford to $300 loss on Tilray for after 1 year is okay. So that's my That was why I took it. So yeah, so we'll keep doing. There's this, the different types of trades. This particular is a custom. I don't know how it will. I will keep subtracting the credits I receive from here every week, and then someday we will see an exit, and then we'll calculate the P&L. Because let's say that we exit someday at $800 from it, and I took credits of -30, -40, -24, -16, and at that point I just, so then my ROI would be very high, 60%, and that's the advantage of playing it like that. But you, on an investment of, first you're lowering your investment cost by taking the credits, and then you're hoping that it will eventually be at $10, and your two holding that $5 strikes will definitely deliver for you. So you keep playing with the weeklies as a seller and hold the long ones, and then hopefully that'll. So that I'm gonna probably hold this trade open for a while, unless it actually does a very asymmetric move and all of a sudden I see like 30% gain here, then I'll probably exit the whole deal. Because if it made that asymmetric move, then that's what I was looking, because I'm holding 2 calls and 1 put, sold 1 call. So I'm looking for that exponential move.
Hi, Mukarram. This is Talal.
Yes.
I remember when you were going into that option trade, either this one or the one in the NEO, you said when you were selecting that trade, you said that that you think that NEO is gonna move, or this theory is gonna do a sudden move. How
Yes.
did you predict it? By looking at the option pricing?
In the NEO, so we did 2 NEO trades. This one right here, the one that was a earnings play,
Yeah.
we remember we made the wings for at $58 on the higher side, and I think was $36 on the lower side.
Yes. Yeah.
So my bet was that it's going to hold itself somewhere in between, right? And the 2 humps that we had were 50 and 40. So the closer it is to 50, we will be better off, and the closer it is to 40, we will be better off. So it ended up being 49. If it was 48, we would still be okay. But 51, 52, maybe still okay. On the lower side, even if, so I looked at that potential move and I thought that, it's not going to go like 60 plus or 30 down. It could have done it, but that's the logic that you have to take the risk.
So
Now,
that was your experienced judgment call.
The stock price movement, I am as good as probably you. I mean, I'm not like, I don't want to take a lot of credit on being predictively, speculatively right on stock price movement. Because if I would know that NEO is going to move in the positive direction, then I would go a naked trade. But the whole point of this strategy is try to stay more neutral. And also, if you're taking a direction on one side, take a lot of time in your hand, like the tilde trade, and then selling the opposite side of it. So I don't want to claim myself an expert in predicting swing trades, and I personally don't think that option traders should do a lot of speculation, because you will lose a lot of money very quickly. This is just my advice. I mean, you could keep doing it and maybe become rich, but I think you have to sell those front month options, front week or bi-weekly or monthly. After 1 month, you could probably hold it. And like Noman said, deep in the money, with at least 30 to 60 days, go for the naked call. Because you're looking at a swing, you think you have a view on something, go for it. I think what he mentioned on that one was really good, because the NEO call on that particular expiry with about, well, let's look at 4 weeks out NEO, like 18 this. Let's look at 18 December NEO, little in the money call, 45. So that to me looks a good $780 trade, right? Out of which that 45, you're already 4.25 in the money, and you're getting 4 weeks for a $300 price. go for it. Maybe, if you are bullish on it. I mean, don't come back to me asking you said go for it, and because in my opinion, market can make an asymmetric move with the virus thing going up. You never know. You can see a 10% day somewhere, right? So I don't wanna give you opinion that where I think it's gonna go. That's something I don't want to take a lot of. Yeah, I'm not too good at it. Let's put it this way.
Okay. And one more question. If you remember, I made a trade on Abbott.
Yes.
I closed that trade, yeah, but I think for some reason there was a gap. There was a big gap, as you mentioned, might be in bid and ask.
Okay, I'll tell you why. Abbott is not very good. Let me tell you why Abbott I never traded it. Look at that volume there. It's few contracts, 57 contracts. Even at the money contracts, weekly front loaded, which should be very high, $110 strike, 195 contracts. Not many people are trading. Look at the bid ask spread. That was the first lesson in the first session. Bid ask spread, liquidity of the contract volumes, this spread. Will you buy a deal? Let's say you're buying a plot, right? Would you buy something that if you want to buy, you have to pay $150,000 for it? And if you are selling it, you can only get $75,000 for it. Would you get into a deal like that? Probably not.
Probably not.
Yeah. Right? But Neo, front month at the front week or at the money option, at the money, let's say 50. Look at the number of very nice 213, 217, and execute at 215. Very nice. That's liquidity you're looking. AMD, AMD front month, front week 85 strike, 10,000, 14,000 contract, 140, 145, 2 or 3 cents. Apple 117 strike, 9,000, 4,000 contract, 178, 185, 183 you'll execute it. So I think Talal, what really hurt you there was that you didn't really, you are getting into things that don't play on those stocks. They're not good for options. Because you are buying something for 150,000, but if you next minute you want to sell it, it's selling for 75,000. Don't do it.
So go to the stocks where the bid and ask price has a less gap.
Two things. Let me tell you two things. This volume here should be thousands.
Yeah.
And at least add the money, the strike, the bid ask should not be more than few cents. So Abbott add the money 110 strike just a week from now, only 195 contracts. I don't really want it. And then look at this 148 and 222. Do not do it. 106, 160, 298. That's not good. I would just close it right there. You have any other darling of the market. Tell me that Netflix.
Let's take Tesla.
Tesla would be nice. I tell you, 490. Tesla would be nice. 5, yeah. So at $1,200, just 20 cents. Yeah, you'd probably execute at 1195 and look at thousands of contracts. So don't play in those other ones. Amazon would be. See, those are huge stocks. You're not gonna. Don't play in too large because the pricing of the ad money is like $1,000. So you are putting a lot of money in one trade because otherwise. So I don't. I mean, Microsoft would be very nice. 210 strike, yeah, 270, 286 with the market close, because when the market opens, these becomes even tighter, and thousands of contracts, 217, yeah.
What about SPY?
It's gonna be fine.
SPY.
Oh yeah, those are very good. These are indices. They are really good. You look at the 355, it will be almost a cent there.
This is the best one.
Yeah, 280. Yeah, they are good. They are very good. 4 cents. So. Yeah, indices, but they don't move a lot. I mean, they're expensive. Look at the volatility. You should not, how much SDS, for example, is one I have traded in the past. SDS is ultra short market. So that one, at the money 14 is, it's a very cheap contract. You see that $14 and only $20 you're paying for the time, and it's almost at the money. But this thing doesn't move. I don't think it's going to move. It's going to probably stay. So market is very smart. They will price them accordingly. Why would they not put it for $40, 40 cents and 42 cents, because then people will sell it. The smart option traders will know that the market is not going to make a 6% move in a Thanksgiving weekend. So they know it, and that's why they price it correct. Well, correct or close to correct. If you look at, this is going to move a lot. So $12 strike. But this problem with this is like this. These are not weekly options. So if you go the next, but the good thing is the contracts are like thousands, and then the bid-ask spread is not that bad, and it's a volatile stock. And so I would actually, this right now, it looks a real cheap option to me. When an electric vehicle stock at 40% volatility for 1 month worth of time, only $2, it probably is fine. If you can make it straddle, actually, it may not be bad. But maybe the market thinks that it's not going to move more than 14 and less than 10 in 1 month. So those are considerations you need to do before you get into that.
And when do you decide to go for straddle or strangle, all these strategies?
So straddles, I like to sell more than buy, because so it's an intuition at the end of the day. If I feel that the implied volatility is really high and it's not going to move a lot, I try to sell. So the way I trade, so let's say NEO was very high, right? So here's what I'll trade. I will see okay, so at 50. So let me give you a trick how to gauge the amount of movement that is priced in. And I think I did talk about straddles in the lecture, but let's see, 49. So always look at the weekly call. So market is expecting the following. 49 strike call is 256 and 233. So let me add those. So you go, probably don't need all of this. So let me, so what the market thinks it's gonna move as a straddle is, so I'll tell you 49 is 256, 2.56, plus you add the same strike. This one is probably 233, right? So you go and add 233, take that number and divide by the stock price. That's what the market is thinking it's gonna move. Market is thinking it's gonna move 10% in this week. Now, market thinks 10% move is in 3.5 days of market time, right? I am tempted to actually do this now. So what I will do is I'll sell these. I'll say sell, because if I think this is not gonna move that much, I'm gonna sell these. What did we say, 49? And I will offset it by buying little time. So I'll probably, this is gonna be expensive trade though. 49 strike here. Yeah, these are going to be expensive here. Yeah, these are going to be expensive here. Yeah, so that's a $1144 trade, but you get almost 2 months of NEO, both sides covered. Now this will decay a lot quicker. So if it doesn't move 10%, those two are going to struggle a lot. And if it does move, your 49, let's say it goes to 60, right? Your call is going to also deliver for you. The one you sold is also going to deliver for you, for the other guy. But overall effect will be, an asymmetric move in NEO will actually hurt you more than gain, because you sold this cheaper than what you bought for. Because your call is $825 and the one you sold is only $215. So then that guy made a lot more money than what you made on that call. And the put options, he lost his whole credit of $290, but then your put is also going to lose a lot. Now there's a sophisticated strategy of one side should be stock, so that you don't. I will talk about that later. I think for now you should take this as an example that you can sell those straddles, the front loaded straddles, but then you are also going to see the decay unless you actually move this really out. So if you move that to, say, April, yeah, but then it becomes a real expense. So I don't like those. $2,000 for holding that straddle for yourself, but then you can keep rolling that every week. Every week you're getting $500 credit. So after 4 weeks, maybe your cost is covered. So actually, it's not bad. You see what I'm saying? Because every week, so for 1 week, you are renting it out for like 290 plus 215, so almost $500-600, right? And that's $50 strike. But what if in that whole time it moves asymmetrically, goes to $70 and $80? Then that guy made more money. I'm not convinced on this trade, to be honest with you. I'm not a fan of straddles. I think those are overpriced generally, and they, unless you are actually seeing, what I do is called hedge straddle. I think we did one of those. Yes.
For the starters, how about iron condors? Are those safer bets if you are bullish? And
reverse iron condor or condor. So you are holding the near terms and selling the outside. Is that what you mean? Or
yes.
So the iron condor is like a butterfly also, but it just has a little wider range. So its curve is, you could do those if you think that the stock is going to halt in the middle. So if you think that, so basically what you will do in an iron condor is that you would make a little space for yourself and say, I sell 55. So you sell 55, say.
Well, let's assume I'm thinking that NEO is going to stay between $60 and $45 range.
Yes. So then you sell the 60 and 45. So let's do that trade. So you think by when? What's your timeline? You think it's gonna
end of this year? It's not going beyond
end of this year. So first of all, okay. So you are selling the one. Let's do 18 December, right? And you wanna sell 60 call. And you wanna between what, 60 and 45?
Yeah, 60 and let's do 40. Right. Yeah, maybe
40. That's fine. Okay, so we are selling 60 and 45 because you get both of these will expire worthless, is what you are saying, right? Because it's not going to go over 60 and it's not going to go under 40. But brokerage is not going to let you do all that naked. So you have to cover. So you have to find your. So then give it like 2-3 weeks. So I would say January would be okay, and then you do a 60 call. 60 call you sell, and then 40 you have to. So this is like a double diagonal actually. This is the same type of trade that we just did here. It's the same type of trade, but it's the cost is 382. So you will actually have to pay 382, and if you are right, then you will be holding for those 3 weeks 60 call and 40 put for yourself. So I think you're just saying that those two will expire worthless for the person, and then after that you are gonna make money if it stays between. So let's take a look at the analyzed trade. Yeah, so the condor is gonna be, yeah, so you okay, so you are gonna make more. Hang on, what's wrong with this?
This looks like a reverse.
Oh, no. It's two of them are there. Wait, I'm gonna fix it. This is not what we want. Oh, I think I screwed this up. But let's do it again. I don't want. Yeah, this one analyzed trade. Okay. Yeah. So basically, it's a similar type of trade we did. You are gonna enjoy if it is close to 40, or if you're gonna enjoy it if it is close to 60, right? Why? Because on that day, let's see, the date is you said what was the, so my expiry is 18 December. So let's go to, no, I want this one. So on 18 December, yeah, so this is the curve. So on 18 December, see, the volatility is gonna keep change, but at 14 December, you will enjoy it if it is near 40, or you will enjoy it if it is near 60. If it's in the middle, according to this, you are gonna be still profitable, but very little profit. So it'll be like a $50 gain on a $382 investment. So it's gonna be 50 divided by 382. So it's not like 13% gain. But that's the worst case. I mean, in a good case, if it's close to, if it is close to your point, let's call it $100 gain. Let's say about $100 here, and if it is somewhere, well, you're not gonna make 400 out of it. But let's say 100. Are you a little bullish on it? Let's say it moved to 60-ish, right? So let's say we make 150. So the 150 case, you are gonna make 40% gain on that. It can happen. I mean, it's not that bad actually, but
I mean, so
yeah.
there are options for us. So if we are placing a bet, we can make it more strategically. That's the whole point.
My only suggestion for you is, why would you give that guy so much time? You would give him only 1 week. So do the same trade on a weekly. So if you do 27 November, well, let's do 4th December, right? So then, there's 2 of them.
I mean, how can I collect credit on this one first of all, and then?
So the ones you sell will earn you credits. The one you have to hold to hedge it, or to actually have a position that offsets it, and that's not 380. 1 second. I'm gonna fix it here. Okay, this is. So I do not suggest you to sell somebody 1 month of worth of time. Always sell them really tight time. So let's try this one. Yeah, so your cost goes up because the credits are lower on that, but then this is going to be over in 3 days, right? If you go 4th December, you are going to make $643 investment. Let's look at the P&L now. Was it 4th December?
I mean, why not sell them something like for 45, 50 days? And
because I think I need to put a graph there, because that's very important to, I believe it was session 2, but let me fix. Yeah, right there, this one. See, the more you sell them more time, it's not going to be in red zone. You want that curve to drop significantly. You want it to really, I would sell right here in that last 7 days, because that's going to really be hard to. And that's exactly the whole point of, is that you sell short term, buy long term. So in Tilray, we have like a very flat curve. This is 120 days. We are like 300, 400 days. We are not going to feel that pain. But this guy is going to feel that pain really bad if it doesn't move. So I would rather sell like 1 or 2 weeks than selling somebody a little bit flat. You can keep selling it. Like after that Friday, sell another one. Do another iterations, but always sell them in this zone. Does that make sense or no?
Yeah, I mean, so yeah, but the value of the option would also be almost zero at that time, right? So if you have to buy it back,
you probably don't have to buy it back, because it will. So this is a very high probability trade. Why? Because chances of this gonna be out of the after plus 60 and below 40 are gonna be very in 1 week, almost. You can see, and plus you're not getting good credit for it, right? 60 call in 1 week time. Did we do one thing? We did 2 weeks, right? 4th December. Hold on, it's not good. I hope I'm not boring everybody, other people, because. So at 60, well, no. 4th December, right? At 60, you're getting very little credit, in my opinion. Almost. Yeah, $133 here and 40.
but how about if you find something with high IV?
Sorry?
Let's find something with high implied volatility and sell that one.
Yes, right. But implied volatility is not the only thing you should consider. There is time decay. This is only few days. What is bothering me is this. Actually, you spotted something interesting. 49 is almost in the middle. Why is that call option so expensive when the distance is the same? So the 49 to 60 is $11, and 49 to 40 is almost $9. But look at the price difference. This is 64, and this is 133. So that bothers me. It means that people are pricing this is going to go up.
Yes,
Are
this
you
is
following me? But I'm,
expensive, right? That's why.
it should be asymmetric, right? If you are, let's take a 51, right? Well, 49 is the price, right? So let's do 40 and comparison of $9 plus 58. 58, see the 58 is $155, which is $9 up, and $9 low is almost half of that. That's very interesting.
It's like
So the
bullish.
trade will be this.
Right? People are bullish on it.
Yes, well, yeah, right there. You can see there's more demand for these. And look at this option volume here. I mean, 7,000, 1,000, all of that. And here it's not that much.
And I think that is one way you can predict the direction of the stock. I think it was Talal who was asking this. So
It is, but this is absurd. Unless we are missing something. 60 strike 4 December. Let's do what other strikes are. 18 December, what's the deal? On 58? But they don't have 58, 60. 60 is about $11, is 292, 91, 291. And 40, yeah, see, this is weird because it should be symmetric. Right? The puts and calls, there's something called put call parity. You can Google it. It's a advanced topic, but there's a put call parity. The pricing is off. You can check that in AMD, it will not be there. I will give you an example. In AMD, 85, so the 95 strike is about 107, and here 75 strike. Yeah, but this is a little bit lower. This is 84, and some generally market, yeah, even this one. So 85. Well, it's a little lower, so 75 will be closer here, which should make it more actually. The 75 strike put is closer because 84.64 minus 75 is 964 out of the money, and $95 minus 84.64. Yeah, so this is a little more out of the money. So this one should be cheaper than that one. Let's change the expiry. So let's say, let's do this one. Probably the same deal, 95. $95 is, well, this is a very little, 33. It's not gonna be, yeah, that's very minor difference. But yeah, sometimes the pricing is a little bit off. Maybe it's the market closed, maybe that day. You have to study this. I mean, but NEO, there was a phenomena. I mean, that's a lot of, it's almost double. You see that? It's the 18th December call, 60 call, right? Which is about the same distance, is twice as expensive as this is like 292. And then at the 40, which is the same distance, almost the same distance. That's very cheap compared to that one. So it kind of indicates that it's gonna probably, market is pricing it that it's gonna move up. Well, we could be wrong, but that's how the option pricing is telling. So yeah, I mean, you can make the decisions, but this is the logic. You have to see what credits you are getting versus what you are net debit, and then you have to figure out if it's gonna decay faster and things like that. It comes with experience. I mean, there's no rule of thumb. The more you look at it, the more trades you do, the more experience you get, you're gonna get better. I mean, even myself, I don't claim myself to be truly an expert in this. I mean, I try to still learn and find things that are there, but it's very hard to sometimes you see something and you place a trade, but you learn from it. And that's why I say, like, don't place too big bets on these options.
So how do you identify the trades that you're going to do? Let's say, how do you identify NEO or Tilray or things like that?
So generally, looking at the bid-ask, the liquidity also. I mean, these are the stocks that have high volatilities and they move a lot. So they're better credits. The front-loaded also. The curve is more steeper, is what I'm trying to say. Is that there's more slope here in the last month versus, so I look at some of that curve shape. The long dated options are not as expensive as the short ones, kind of almost vertical drop towards the end. So that's one approach. The other was I saw, like I said, I thought it was very close to the support. When I was at 6.6 or 6.7, I thought that worst case is going to go a little bit down. I can get a couple of credits in the meantime, and 2-to-1 straddle will be, 2-to-1 spread will be good. And then it overall cost is $614, and 2 or 3 times I roll it back, I'll be 500 in no time. And then I have, if it drops really low, like $4 or $5, I will stop selling and I'll hold it as an investor. I will invest in for 1 year, $5 strikes, 2 calls. Mm-hmm. So that was my, I mean, there's no formula here. I mean, you have to see like what is out there and see what comes in your strategy. And it's a very difficult question to answer. Like there's no clear answer. Like I generally try to use intuition like this and some of the techniques that I'm trying to tell. But you learn over time, like the types of trade I'm placing. Now, hedge straddle is a good strategy. I mean, if you really, for Neo, honestly, I think it can go to $100. Or guess what? It can be back at $25. So a straddle, but then what if it halts there at 50? 50 may be the right price, at least for next 3-4 months. So then that hedge straddle means that selling those out of the money contracts will lower your cost. So maybe that's a strategy. 2-to-1 hedge straddle will be a good one for that one. So every stock has a different price point and calls for a different strategy. So that's why I think there's no set pattern there. Like Neo earnings play it worked out for us, but I was not too happy about it by the way, because yes, we got 31% gain, but we should not have sold at 27. We should have sold, we should have bought at least 18 December, because then we could have rolled it 1 or 2 more times and got more credit. This gain could have been like more, but I did not want to put a lot of money in it. So the investment was only 191. Obviously you can multiply the number of contracts, everything by 10, and it'll be like 1,911. But then gains are strong. But what if the trades go wrong? Then you are on the losing end. So I generally try to keep those small trades just because I don't want to take asymmetric losses. And you will see losses here. You will definitely see losses here and big ones also. But hopefully we'll try not to make them very asymmetric and very big. Our goal is to keep it at 70% strike rate and try and have double-digit gains and cut the losses to 25%. When we think that it's not going to go high and it's going to keep, what we saw in the trade didn't work out. So then we'll try to cut it around 25% or so. All right. For about an hour and 15 minutes. I don't have any problem, but I think it's a continuous process. You're not going to learn everything today. Just keep in touch. Maybe we can do this once in a while where we can talk about different options, like how we're trading, how we're going. You're gonna become expert in no time. Few months here. If you're trading more and more with this, you will get really good at this.
Awesome. Thank you so much, Raheel bhai.
Okay, I will.
Thank you so
any
much.
other questions?
Thank you.
Sure. If there's no more question, I'll just simply end it and let's keep in touch. Let's see if I can find more trades. I don't know how much time I'll get during the day, but whatever I get, I'll see if it makes sense to put it in our trade log and actually make it an official trade or not. And then we'll keep going. And those who have not the real accounts, just keep putting in their virtual account and please see the mechanics of how it works. Okay?
Okay.
All right, good night. We'll talk to you soon.